First, big picture. Let's talk about what's kind of just driving this run in gold. You put it like this, Dave. You say the move to all-time highs isn't just about fear, it's about fundamentals. Explain that for us, David. What do you mean?
Well, so it's certainly not just one thing. So I guess to start, an easy way to think about it would be those China tariffs you just mentioned. If you think about it, if you're China and you're running the Chinese central bank and you own 760 billion of U.S. Treasuries, and you just saw that the U.S. was threatening 100% tariffs, and you saw that back in 22, the U.S. seized 300 billion of Russia's dollar-denominated assets, you'd probably feel a lot safer if you held 760 billion of gold bars in a vault in Beijing that we couldn't take at the flip of a computer switch. So that's probably a starting point, is you have these price-agnostic buyers, and it's not limited to China. They're not the only people we put tariffs on or indicated that we may not agree with their policy and don't want us to have that leverage. So they're an enormous buyer, over 1,080 metric tons last year, and they'll likely do more than that this year, meaning the central banks, particularly of the BRICS nations.
Central bank.
Gold has just smashed through $4,100 an ounce, setting a new all-time record. But here's the twist. This rally isn't just about fear or panic. It's about a massive shift in global power and currency trust. Central banks are quietly dumping U.S. Treasuries and hoarding gold like never before. This could mark the beginning of the end for the dollar's dominance. Let's take a look at the latest report.
What about U.S.-China trade tensions? I mean, you saw that caused a freak out in the markets on Friday. What role do you think that's playing here?
I think that's pouring even more gasoline on the same fire. So, there's already this concern. We already had these tariffs earlier. We already had specific Chinese sanctions. So any addition to that just makes people want to transition off the dollar faster and buy more gold as a reserve asset.
Let's put some numbers on this. What are your gold targets? What do you pencil in?
So it's obviously been moving pretty quickly. We just got over 4,000 an ounce not too long ago, then starting to crack 4,100. I think middle of probably end of this year, you're probably looking 4,500. You could even see 5,000 plus a year from now. A lot of it obviously depends on those fundamentals and how they shift over the next few months and year.
For gold investors who are listening right now, what are, David, near-term risks you would emphasize that they need to have on their radar?
So obviously the price has obviously moved a lot. So whenever you see an asymmetric move like that, there's always the risk that it will retrace. I think the reason that's less of a risk right now is we have the Fed lowering interest rates. That's generally good for both bonds and gold. You also have the central bank buying. That's generally accelerating. So that's also pretty good for gold. Obviously, if either of those were to flip, and they flip to raising rates or they flip to central bank selling, that would shift it. But there's no indication that either of those two are likely to happen. And then you also have deficit spending, which is the other big driver, which is also weakening the dollar because when you have 37 trillion in debt outstanding and you're running a $1.9 trillion deficit that was kind of enshrined into law in the big beautiful bill, those factors are very structural. So obviously if any of those shift and they flip to selling or they start raising rates, or we see the government decide to run a balanced budget and create a new bill that reverses previous ones, that could change. But I don't think that's terribly likely in the near future.
So those are.
Now, here's what most people won't tell you. This isn't just about fear of tariffs or another safe haven play. It's about de-dollarization in motion. After the U.S. seized Russian reserves and threatened 100% tariffs on China, nations like China, India, and the rest of the BRICS are moving out of U.S. debt and into physical gold. That's a price-agnostic shift. They're buying no matter what the price is. Meanwhile, the Fed is cutting rates, deficits are exploding past $1.9 trillion, and the U.S. dollar is losing credibility globally. Combine that with central banks stacking 80-plus metric tons of gold last year, and it's easy to see why analysts are now projecting $4,500 to $5,200 per ounce within a year. And here's the key. When both fear and fundamentals align, you get a super cycle, not just a rally.
So those are near-term risks. Would there be some potential near-term positive catalysts? Would it be like the next FOMC meeting?
Certainly. So, if the Fed decides that they're going to loosen policy and cut rates more than they've already indicated, that would certainly be a net positive for gold. If they decided that they were going to cut less or not cut, that wouldn't help gold prices. And you can think of gold in relation to the dollar from that perspective. Whenever the dollar weakens, that's a big net positive for gold on a relative basis.
What have gold ETF flows been like?
So gold ETF flows had been flattish the past couple of years in spite of the rising price, whereas year to date they've really started to take off in a much more significant way. They're not nearly as big as the central bank net buying, but that's an additional part of that cycle. The price escalation has attracted more buyers. It's certainly one of those situations where it's kind of a bit of the opposite of the store sale. People like buying gold more when the price goes up, ironically.
This is the Cryptagon. Stay sharp, stay informed.